Hello again. In the first episode, I talked about the importance of learning personal finance management skill and the common financial mistakes we usually do, right? Today, let's explore the concept of income and expenses, active versus passive income streams, and the importance of passive income. Have you ever heard the terms active income and passive income before? Even if not heard, don't worry. In this episode, I'll explain what these terms mean and why passive income is important. Just a standard disclaimer as always, mainly that this video or presentation is for education purpose only and should not be treated as substitute of professional personal financial advice which differs person to person. Okay, so first let's define what active income is. Active income is money that you earn by spending most of your primary time and skills. For example, if you have a job, you get a salary, bonus, perks, etc. Or if you are a businessman, industrialist, professional, or a freelancer, you earn profits from that work. These are active incomes. You are actively spending your time and skills to do some work to earn that money, isn't it? You may have more than one active income also at a time. It requires ongoing effort and time to maintain or increase it. When you stop working, the money stops coming in. This stoppage can be due to age-based retirement if you are in a job, or discontinuation of your business, profession, or any sort of physical disability or your death. On the other hand, the passive income is money that you earn without actively doing work. It requires little to no ongoing effort and time. It's an output or a byproduct of your personal finance activities. Once you set up a passive income stream, you can earn money without actively working for it, even after your active income stops. Some example of passive income sources include rental income from real estate or dividend or capital gain from stocks or mutual fund, interest from deposit in various saving schemes like FD, PPF, NSC, KVP, corporate deposits, annuities from pension schemes, royalties from your intellectual properties like books, music, artwork, etc. In short, for the active income, you work for money. For the passive income, money works for you. You will stop working one day for some or the other reason, age-based retirement, or you lose your job for some reason, or your business or profession has to be discontinued for some reason, health issues, and your active income will stop. But if you can put your money to work, it won't stop working for you even if you do. Care for your money like your child, and it will care for you like its parent. I can't assure the same for your biological child though, but I can assure this for your financial child. While active income is necessary for most people to cover their regular living expenses, having a passive income source is incredibly important for building long-term financial security. It gives you the freedom to create the life you want without being tied to a job or a location. Let's understand it differently. Imagine you are a farmer who wants to harvest apples. You can either plant a single apple tree, which will require lesser effort and time to maintain, and then wait for it to grow and produce fruits each year. Or you can plant an entire orchard with multiple apple tree that will produce a bountiful harvest for years to come. Obviously, you'll do the latter and plant multiple trees, right? Because a single tree will give you a limited harvest, limited income, and you will also be at a risk of losing the entire income if the tree is damaged for some reason. The single tree is your active income. The apple orchard, on the other hand, represents passive income. It takes more effort to plant and maintain an entire orchard, but once it's established, it will continue to produce a steady stream of fruits year after year. And the best part is you can diversify your income by planting other types of fruit trees in addition to apples. Just like you can diversify your passive income portfolio by investing in different asset class. So relying on a single source of income is always risky as it leaves you vulnerable to unexpected events that could impact your ability to earn that active money. Let's look at some of the risk of having only one source of active income. Job loss or business disruption. If you have a single job and you lose that job unexpectedly, you could be left without any income at all. This can happen due to company layoff, downsizing, inability to manage business, or other unforeseen circumstances. It can make it difficult to pay for regular expenses and meet your financial obligations. We have noticed this in 2008 financial crisis, in 2020 COVID crisis. It happened with many people. Economic downturns, if you work in an industry that is vulnerable to economic downturns, such as hospitality sector or aviation sector in the COVID year, your income could be impacted if the industry experiences a downturn. It can again lead to financial instability and difficulty in meeting your financial obligations. Lack of diversification. By having only one source of income, you lack diversification. It's important because it helps spread the risk across multiple sources of income, reducing the impact of any one source of income failing. Then the health issues. If you become ill or injured and are unable to work, you may lose your primary source of income. This could be particularly challenging if you have high medical bills to pay as well, right? Technological disruptions, AI, artificial intelligence, we heard about it. We have heard about automation in various sectors, right? As technology continues to advance, several jobs are becoming obsolete and industries are transforming. If your job is at risk of being automated or replaced by technology, you could be left without a source of income unless you upskill yourself. Limited growth potential. If you only have one source of income, there may be very limited opportunities for growth and advancement. This could limit your earning potential over time. In summary, having only one source of income can be risky because it can disturb your financial stability at any point of time, because it can cause tremendous stress, adversely impact your health. Even if not, it won't upgrade your lifestyle. That's where the passive income becomes so important. Passive income can provide you with financial security by diversifying your income streams and reducing your reliance on a single source. Passive income streams can help you weather any such unexpected events. Thus, you can have greater control over your financial future. You can choose which passive income streams to invest in, their multiple, and how much time and effort to allocate to each one. Passive income can give you more freedom and flexibility and can help reduce your stress, burnout that can come from relying solely on active income. If you're constantly trading your time for money, you might not have as much control over your schedule and your life too. With passive income, you can have more control over your time and how you spend it, and can potentially create a better work-life balance. Unlike a traditional job, which typically requires you to work set hours and be present at a specific location, this passive income streams can be generated from anywhere at any time. So this provides you greater flexibility in terms of how you manage your time and where you work from. Isn't that great? Passive income can help you achieve your long-term financial goals. By investing in these streams, you can build wealth over a time, create a more stable financial future for yourself and your family, and upgrade your lifestyle regularly. Passive income streams have the potential to scale up over time, meaning that your income can grow without any additional effort on your part. Of course, it's important to note that creating passive income streams takes time and effort upfront. You'll need to research different options and invest money and resources into setting them up into something which you understand. But if you're willing to put in that work, the long-term benefits can be significant. So whether you're looking to build financial security, gain more flexibility in your life, or achieve your long-term financial goals, passive income is an important tool to have in your financial toolbox. Now this is important. This is a freehand chart I have drawn to demonstrate the concept. Do not scale it, it's a freehand chart. The red line shows rising expenses over years, and the green line is your active income. And you all will agree with me that the expenses are forever. Whether or not you have any income, the expenses will be there. And that the active income will stop one day for everyone, for every family, for some or the other reason. Now the blue line shows your passive income, and note how this curve actually moves. By the time your active income declines or stops, you must ensure that your passive income is more than your expenses and debts, if any. so that you don't have any stress about meeting your financial obligations when your active income stops, and you don't have to downgrade your lifestyle. You must also ensure that you have invested in such assets which gives you compounding returns year on year. Now the compounding looks slower in initial 10-15 years, but it shows its real magic only after that. So these initial years, these initial slow years should sync up with your active income when you can invest in the passive income sources and stay invested. If you have crossed at least 15 years or so in the passive income assets, most likely the compounding returns will continue to fetch you much more money than your expenses, even after you keep withdrawing the returns periodically from those assets. So pause here, spend some time in looking at this graph, understanding it, then assess where you are financially right now and what you need to do to achieve these goals. For any guidance, you can always book time with me. Trust me, this is not unrealistic expectation. I have achieved it myself, so I know it's possible and it's easy too. You need to start early and learn, of course, from the right sources. I started my passive income journey a few years late after my active income started, and that's bad. Now the key here is to select the appropriate passive income streams which can fulfill your goals. Let's take a look at few common options and their pros and cons very briefly. I shall dwell into the details of each of these in future videos when I talk about the retirement planning and investment strategies and options. For now, we will keep it brief. The first one is rental income from residential and commercial properties provide a steady income, through the rent collected from tenants. This is one of the most common sources people have in India. Owning real estates comes with its share of headaches, isn't it? To buy a property, you need lump sum money, either your own money or you borrow from somewhere. And then managing tenant, repair and maintenance of the property, dealing with property taxes, insurance. Plus, in case of emergency uh, and you need lump sum, the liquidity is very low. It's not very easy to sell a commercial or residential property and liquidate that assets. The returns to rental yield is usually in range of 3 to 5% of the property value, isn't it? Maybe slightly higher in case of commercial ones. Like a 1 crore 2 BHK flat will typically fetch you a rent of 30 to 40,000 per month, which actually is a negative return post tax, post inflation. Dividend income. It is generated when you invest in stocks or mutual funds of companies which are profitable and that distribute their profit regularly as dividend to the shareholders. These are especially government, PSUs, and some mid-sized listed private companies. It's a fairly liquid assets. You don't necessarily need to invest lump sum here. You can buy stocks or mutual fund periodically as and when you have funds. You can do SIP. Just keep accumulating shares of few good companies in bits and pieces and no need to borrow at all from anyone. The challenge here is to do good research and successfully identify such companies and regularly monitor to ensure that the companies you invest in are stable and profitable. The other challenge is to deal with the volatile nature of the stock market. It requires tremendous control over your emotions, especially fear and greed, so as to avoid any irrational panic buy or sell action at inappropriate times. This provides not only dividend income but capital appreciations too in form of stock price appreciation. Interest income received from various saving schemes like saving bank, FDs, PPF, NSC, KVP. These fixed income investment options have restricted liquidity due to lock-in period for your capital investment, and you need to calculate your cash flows very accurately, especially any of your lump sum monetary needs, so that you spread your investment across various schemes in such a way that some or the other deposits are maturing sometime before you need it. Returns are fixed interest as per the scheme. Important factor is to not get carried away by the published interest rate. always calculate the real return you will get post tax, post inflation. People just look at the published interest rate, they forget or they are not aware that they have to factor in the tax and inflation component too. Example, a 9% fixed returns looks very attractive, isn't it? But if you are in a 30% tax bracket, then with 6.5% inflation, your real return will be zero, almost zero. And at 20% tax bracket, the real return will be 0.7%. Too low, isn't it? Yeah. Systematic withdrawals from mutual funds. If you do a SIP or invest lump sum in mutual funds, whether equity or debt, over a long period, say 10, 15 years plus, you can systematically withdraw some money as and when you need. It is highly liquid asset. You can redeem at any interval, not necessary every month or quarter or every year. Returns are much higher than the fixed income instruments and usually in double digits, and due to lower tax impact, not taxed on accrual basis but taxed only when and to the extent you redeem. The challenge here is to research well and identify appropriate mutual fund scheme as per your goals and risk appetite, and then manage your emotions during economic downturns due to volatile nature of the asset class. Aha, this is most popular. Annuities from pension or insurance scheme usually paid by the financial institutions on periodic basis. Each of you would have heard about these schemes from your banker or insurance agents, I'm pretty sure, where you are asked to pay one-time lump sum amount or on an annual basis for first 8 to 10 years. Then after certain number of years or retirement, the company will start paying you an agreed amount annually, isn't it? Look, sounds familiar? Now the challenge here is the real returns, and the future value of money received is usually not enough to beat the inflation and even maintain the same lifestyle as it is currently. The absolute amount looks lucrative at current time period when it is shown by the agent, and people usually do not know how to calculate the future value of that amount. The capital is locked forever and usually cannot be withdrawn. So in case of a need of a lump sum money, you have to borrow when you could actually have used your own funds had you invested elsewhere. So in my personal opinion, and this is completely personal opinion, not generalizing for any of you, not specific to any of you, it's completely personal. This stream of passive income should be completely avoided, irrespective of your risk appetite and future financial goals. There are much better alternates available in the market. This is the most aggressively sold investment option by nearly all bankers, relationship managers, and insurance agents. That itself is a red flag. Any financial institutions won't actively sell something which is less beneficial to them and more beneficial to the investors. The intellectual properties, the royalty from intellectual properties, like books, music, artwork, can generate passive income from the sales or licensing fees. But the cash inflow here is irregular, usually, as it depends on the sale and use of your IPs. Creating high quality intellectual property also requires significant upfront investment in time, resources, and efforts. So yeah, these are various sources of passive income. You have to pick the ones which most suits you. Do not copy others. And then nurture it like your child, and it will always stand by you whenever you need it. Find the right balance or the right combination of investment options to meet your future financial goals. And the goals must be realistic in accordance with your emotional mindset, your risk appetite, your current financial state, your current age. I shall talk more about goal setting in one of the future videos when we get to the financial planning topic. But the key factors you need to consider while choosing the right asset to invest for passive incomes are fund requirement, liquidity of those assets, the real returns of those assets post tax, post inflation, diversification you need, and the ease of managing the assets. So do think over this and start focusing on creating and increasing your passive income. When you have multiple streams of expenses and cash outflow, why should you have only one or two streams of income or cash inflow? Think about this now. Ask me if you need any guidance. You can book my time on email or WhatsApp number below. And most important, act upon your plan. You will thank me later for this. Cheers and happy investing. In the next video, I will talk about expenses and the tools to manage expenses. Yeah, we put in lot of thoughts, time and energy in creating this video. So if you're finding this useful, please do share with others too and do subscribe to our YouTube channel. Thank you.